All right, let's get into it. Goldman Sachs just dropped their brand new 10-year forecast, and today we're going to unpack the whole thing. We're going to see where one of the biggest investment banks on the planet thinks the best places to put your money are for the next decade. I mean, it's the big question, isn't it? How do you even begin to plan for the next 10 years? After the incredible run we've seen, especially in US stocks, trying to figure out what comes next can feel, well, pretty much impossible. Well, it might not be a total guess. Goldman Sachs. They have an idea. They've gone and crunched the numbers on pretty much everything, earnings, currencies, you name it, to paint a picture of the financial world for the next decade. And this is it. This is the big headline number they landed on for what we can expect from global stocks. So 7.7% per year on average. Now, that's a pretty solid number. It actually lines up really well with the historical median. But, the number itself isn't really the most interesting part. The real story is how they got there, because that's what tells us what it means for different parts of the world and for you. So let's dig in. Okay, so first up, let's look at the big picture. And you might be surprised to hear this, but Goldman's forecast, it's actually a lot more optimistic than you might think. So why do I say that? Well, if you use a classic tool, something called the CAPE ratio, to look at today's high stock prices, you'd probably expect pretty lousy returns, something less than 5%. But Goldman is saying, hold on, that's only half the story. They believe that the super high profit margins companies are enjoying right now are basically here to stay. And that just completely changes the math for future returns. So how can they be so confident about that? Well, it all comes down to their method, which is really cool. It breaks down every single dollar of investment return into just 3 simple, understandable pieces. They call it the building block approach. And honestly, it's a powerful way to think about investing, because it just cuts through all the daily noise and focuses on what actually creates value in the long run. And here they are. It's really simple. The first block is earnings growth. Straightforward, right? How much more profit are companies actually making? The second is valuation change. Basically, will people be willing to pay more or less for those profits in the future? And the third is shareholder yield. That's the cash that comes straight back to your pocket through dividends and buybacks. That's it. Every penny of return has to come from one of those 3 places. And this chart just lays it out perfectly on a global scale. You can see right away, earnings growth is the absolute hero here. It's doing all the heavy lifting, chipping in a massive 6.2%. Dividends add a nice solid 2%. And that valuation piece, well, because stocks are a little expensive today, it's actually working against us. It's a small drag, pulling returns down by about 1% a year. You add it all up and bingo, there's your forecast. Okay, so that's the view from 30,000 feet. But this is where the story gets really interesting, when we start zooming in on different parts of the world. And whoa, look at that. It is not the same story everywhere, not by a long shot. The US is forecast at 6.5%. Europe is actually a little higher at 7.1%. And then you've got emerging markets, just way, way out in front with a massive 10.9% annual forecast. So the big question is, why? This table right here tells the whole story. For the US, you've got strong earnings, but its high valuations are creating the biggest headwind. Then you hop over to Europe, which is a much more balanced story, where those payouts to shareholders make up a huge chunk of the return. And emerging markets, it's all about one thing, that supercharged earnings growth, which is so strong it just powers right through the valuation drag. So for the US, think of the next decade as a battle between a rocket and an anchor. You've got these fantastic companies just churning out profits. That's the rocket. But the market is already pricing in so much of that success, and that high starting point is going to act like an anchor, holding back the total returns. Europe is a completely different game. It's not so much about explosive growth as it is about steady, reliable cash returns to investors. In fact, Goldman expects that dividends are going to make up almost half of the total return you see from European stocks. It's a great reminder that growth isn't the only way to win. And then, of course, we have the growth engine. Emerging markets are forecast to deliver by far the strongest earnings growth anywhere on the planet, driven by places like India and China. Now, it comes with more risk for sure, but for investors looking for the highest potential reward, this is where Goldman is pointing. Now, let's be real, no forecast is ever set in stone, and Goldman is quick to point out 2 massive wildcards that could come along and just change this entire picture: artificial intelligence and the US dollar. On the AI front, they see it almost purely as a positive. If AI boosts productivity even more than we think, it could just supercharge earnings growth across the board. And the key here is that Goldman doesn't think this is just a story for a few US tech giants. They think the benefits will be felt by companies all over the world. The second wildcard is the dollar, and this is a big one. Goldman's own currency team thinks it's likely to get weaker over the next 10 years. And as this quote explains, for a US investor, that's like a double win for investing abroad. Your foreign stocks become worth more in dollar terms, and a weak dollar has historically been when international stocks just plain do better than US stocks. Whew, okay, we have covered a lot of ground, so let's boil this all down into 5 key things you should take away from this report. First off, the main message is, don't panic. The outlook is actually pretty good. Despite all the worries about high valuations, that 7.7% global forecast suggests stocks should continue to be a really rewarding place to be for the long term. Okay, takeaways 2 and 3 are really a pair. Number 2, remember that earnings growth is the engine. It's what's going to power returns. But, and this is takeaway number 3, today's high prices are acting like a brake. And because of that tension, the cash you get back directly from dividends is going to be an absolutely essential piece of your total performance. And that brings us to the final 2 big points. Number 4 is the big strategic call. After a decade where US stocks were king, this report strongly suggests the best opportunities might now be somewhere else. And number 5 is the why. You've got a potential weaker dollar and stronger growth abroad, which together make a really powerful case for global diversification. Which really brings us to our final question. The forces that drove the market for the last 10 years might not be the same ones that drive it for the next 10. So it's worth taking a hard look at your own portfolio and asking yourself, are you ready for what comes next?